Hello everyone and welcome to Jim Dalton's presentation, Fresh Start for the New Year. It's January 4th, 2016, 9 a.m. Eastern. Jim and I want to wish all of you a very happy new year. It's great to have you all here. Thank you for taking time out of your busy days to be here. We have a busy hour ahead. We need to have a hard stop at 10 a.m. so we apologize for any questions that aren't answered, but we need to stop on time at 10 a.m. Also, this webinar is being recorded. We'll have it up on the site probably around 1 o'clock Eastern. And lastly, there are two reports that I used, a new feature on GoToWebinar that I put the reports up here for you to have. I'm not sure how that's working on your end. If you cannot access them from the dashboard at GoToWebinar, please go to jdaltontrading.com, resources, webinars, upcoming webinars, and you'll see two hyperlinks there with this webinar post that you can download the PDF reports for today. Okay, so thank you everyone. Great to have you, and please put your questions in. We'll get to as many as we can, and I will turn it over to Jim. Good morning, Jim.
Good morning and Happy New Year to everyone. It's doesn't look like a very fresh start, does it? It's a new start, but the first thing that I want to cover is to a lot of people, this opening today would seem like a huge surprise and coming out of nowhere. I want to go back and I want to look at the 22nd of December. I'm going to make this fairly large. Here is the 22nd of December, and this is a day where the market rallied. You have what we call very poor or terrible structure. You have an area in here, and there's a point of control. This first distribution, we'll call it, here's the point of control. The point of control did not rise all day long. You have, this is an anomaly here, meaning it just doesn't look natural relative to the rest of the profile. You have another anomaly here. You have multiple distributions, an anomaly here, an anomaly here, another distribution here. It is just an absolutely terrible day from the point of view of market structure. View structure as you would the flooring that you would put in a house, the 4x4s or 2x4s that you would put to hold a house up, to give it strength, give it structure. The weaker the structure, the easier it is going to be to come back through that structure at a later date. And this is something, the market profile records the market's continuous two-way auction process. We are not profile traders. We are full traders, but we look at the structure of the market. The market profile organizes the market's continuous two-way auction process. When we look at this underlying structure, I can see that this is very weak. Now, a lot of that is through doing this for years and understanding what is good structure and what is weak structure. This is very strung out. Now, the market then gapped higher the following day. And again, you had very poor structure. The market broke, went back on up, and then of course, you know, we have the final break, and now today. But and we'll get more into that in a second. But the point I want to make is that this rally that started on the 22nd was more than likely non-thinking traders say, oh boy, this is the traditional Christmas rally. If I go long this rally, I'm going to make a lot of money. And we're not saying not to pay attention to this. When the market starts to rally like this, you do not want to step in front of it. Those are the people that you are competing against all the time. With momentum trading, and it's interesting because when I looked at this rally, coming up and bringing the market all the way up into here, this was the first leg, then it broke, then it rallied again, big gap up here again. I looked and I said, this is weak hands. The market is getting into the weakest hands possible. These are basically momentum traders. Momentum traders are like a herd. Early on, it's fine. It's fine to be early on. But later on, they take it to extremes. Momentum trading itself, if you don't know how to read the underlying structure, can be very dangerous. If you have underlying structure that is strong, that momentum may go a long way. If you have underlying structure that is weak, then more than likely that momentum rally that we've just been looking at is going to set the stage for a more substantial reversal down the road. Also, when you get rallies like you had on the 22nd, which really kicked this thing into high gear, you're forcing the shorts to cover. Short covering can weaken a market as it takes out the potential buying power. So the market more than likely went from too short to too long. So not only did you take out the potential buying power, but you added in a lot of weak longs. There was no structure, there was no volume to indicate that the longer time frames had anything to do with that rally. So now there shouldn't be any great shock when the market comes back down through all of this as it did today. Yes. Did we have some unusual things take place? Yes. The Shanghai index was down 6.7% before they stopped trading. Do we have a global sell-off to start the year? Yes, we do. But the market got up to an extreme and no follow-through. Now, the first thing I did today is I talked about the weak structure as this market was rallying. So the structure as the market was rallying was very weak. Even this, we gapped higher, we came down to this day right here on the 28th, we got down to unchanged from this day, and then the market one time frame for the remainder of the day. So the structure rallying up was very weak. However, now I'm going to change the thinking a little bit. You've got a market that is down 300 or 400 points. I don't know exactly what the last trade is, but you're down substantially this morning. Just as the market rallied on poor structure, this current break is also on poor structure. You have a prominent point of control from the 30th, and that prominent point of control has not been revisited. You have another poor day on the 31st. Here's a prominent point of control. The market is it's up in here. That should be, it's not been revisited in the day time frame. Yes, it was revisited overnight, but not in the day time frame. Now you have a very large gap to the downside. Your structure going up was poor. Your structure coming down is also poor. And the reason I want to stress this is because when you see a market break as hard as this market did, it is very easy to get cognitive dissonance and say, wow, this market is really going down forever. And that may be the case, okay? That may be the case, but it's not necessarily the case. If you got the report that I sent out for today, not the morning report, but the recap and preparation report, it was for this morning, but not the morning, we update this morning. That report talked about the potential for a weekly scenario. And the weekly scenario was, we said that the structure was poor both above and below where the market was currently trading. So we said there was a potential with the poor structure above the market, poor structure below the market. What I saw was the potential for volatility. And the potential for volatility is that the market could trade both ways before the week is over. I know it doesn't feel like that right now when you look at where this market is, but that's something you need to keep in mind, that the structure coming down isn't any better than was the structure going up. Now this morning, the references, we have a huge gap to the downside. So inventory has probably gotten very short. Psychologically, the market's more than likely going to be looking at the 2000 level here. The overnight high and low are always significant references. If we're going to go lower today, if we don't get and find acceptance below the overnight low at the 1995 level, then you got a pretty good odds that you're going to get a short covering rally. If you get acceptance down below the overnight low, then the market's very visible and it's going to start looking at these next lower references, 1991, which goes back to, I guess that's the 18th or 17th, and then you've got another low down here at the 1983 level. So those are the next visible references that we have this morning. The larger the gap, and this is of course a very large gap, the larger the gap, the lower the odds that that gap is going to be filled, the lower the odds that you're going to get a substantial rally from it. And the reason being is there's so many traders with dislocated positions that they have to cover. They have to cover their long, or they have to meet margin calls. And a lot of these people do not trade overnight. So when you have a gap of this magnitude, it is very unlikely that the gap is going to be filled or even a substantial rally on the first day. If there is a substantial rally on the first day, more than likely what you're going to see is you're going to see it start early and you're going to see the market one time frame higher. One time framing just means that the next bar, if you're going up, does not take out the low of the previous bar, at least not by 2 ticks, and it just keeps marching higher throughout the day. So do I have confidence in this market up or down? No, I do not. I haven't liked the market all the way along, but it has been going higher. So right now, as we get ready for today, and the market's going to open in about 18 minutes, we have a large downward gap. It's not an unexpected downward gap, basically foreshadowed by this move that we were talked about here earlier with the structure with no real structure to it. When you have no real structure, and notice this whole area right in between about the 2030 on the high and I'll come down about the 2020 level, there's no real structure in there, no backing and filling, no congestion in that area. So when these markets start to break, they can break very hard. Also, when they come down like this, it can go up very hard because there's no structure to hold it from going back up. It's just a very difficult time for traders. But the important thing is that we make fresh start. But markets, what is happening today, an awful lot was set up last year, and particularly on the rally we saw, this very weak rally we saw, and I believe the day was the 22nd. Okay, now, so we're going to open in a few minutes. Let's take a few questions, but before we take those questions, the things that we're talking about here are related to the structure of the market. There is nothing that you've heard talked about today that you will see from most other people that talk about the markets. We look at them totally differently. We have recommended that you read Brett Steenbarger's latest book, Psychology 2.0. And in a sense, I kind of wish we hadn't recommended that, because in the book's divided into 3 sections. In the first section, it really talks about change. The second section talks a lot about, the individual and your involvement in the market. And the third covers a lot of material, and it goes over a lot of different ways traders trade and things that they look at. I really loved the first 2 sections. I had some questions about the last section, but it's a wonderful read. But in there, and one of the shocking things in the last section, talks about on a 3-year basis, the people that do short-term trading, the success ratio is about 15%. When they take that over a 3-year period, or a longer than 3 years, those same traders, it drops down to as low as 0.13%. So, and I know that's shocking, particularly when we're selling educational courses, but you need to know that. And the reason it's important is to think about the traditional things people do and look at in the market are not delivering the results that they would like you to believe that they do. I don't know what the results are from the people that we have as clients. I do know that what we teach is substantially different than you're going to see anyplace else. Okay, with that, we're down, we've got 14 minutes to go. We're down near the overnight low. That is our first reference. Julia, let's open up for some questions.
Okay, great. Thank you, Jim. Would Jim label the long-term and intermediate-term trends as balancing since he sees no directional bias? I don't know if you have your TD Ameritrade.
No, I don't have it up. I will put it up. I'm sorry, I don't. I will have that up in just a second. The answer is yes, I do see that as, I do see the market as balanced, and I'll have this up in just a second. There is no
Well,
direction to the market. Pardon?
the report has the weekly and the monthly charts on it too.
Okay. Well, I'll have it here in a second. But yes, I do see it as balanced. What we wrote all last year was we never saw a good high on the market, and we've never seen a good high since the 2014. And we saw it without a convincing high. We thought the odds were low that the market would have a big sell-off. Hold on here. And that happened. Actually, I wouldn't have been too surprised if the market didn't come back last year and test the high. It didn't make it. But because there was never any real completion to that market, we never saw the big sell-off. The market kept coming back. But yes, we do see the market as balanced. That'll come up here in just a minute. Okay, while we're waiting for this to come up, let me take another question.
Okay, great. Thank you, Jim. Does a low volume lessen the importance of that very prominent POC from I believe she's talking on December 31st, because it was such a light volume day in the New York Stock Exchange?
No, they're still relevant. they're still relevant. The whole market, I mean, to me, the rally up was very weak, but the break to the downside wasn't anything dynamic either. But yes, no, I will keep that. I already pointed out when I started this morning, I'm still looking at that point of control from Friday, and I'm also looking at the point of control from the day before. Okay, here is this is a weekly bar. Let me go over here and do this on a okay, there's the monthly bar. And we go back. This is the 2014 low, 2015 low. So as I see the market, the question was good. I see the market in a balancing atmosphere. Remember, the way we look at things, markets do not go from bull to bear. They go from bull to balance or trading range, back to bull, or bull balance to trading range, back to bear. They very seldom get a V-shaped market that goes from bull to bear. And that is what is going on right in here. So now I've got the low end of this range at the, I believe that is 1813. So my range is 1813 up to the high at 2132. So we can chop around in this area. I mean, that's a pretty broad swing in there, but there's really no substantial change taking place unless we get down below the 1813 level. So I see us in a trading range. What are we going to open at? We're about the 2000. So there's about the 2000 level right there, which is going to put us, right around this level right here. So, that puts us, we're still in about the upper third of that trading range. Okay, additional questions?
Yes, thank you, Jim. Would you even bother with scenarios with this market? And would you place any emphasis on levels hit?
Yeah, yes, these scenarios, and they have to be rewritten because of what has happened today. So the first scenario is going to be the overnight low. And that's, so I'm going to take my first two scenarios are going to be, if we don't, and I wrote this up in the morning report, if we don't take out the overnight low following the opening, then the chances are pretty good that we're going to get a short covering rally. And it just makes sense that the markets come, all of this, you've had this liquidation, so you had liquidation from people that were long, that wanted out, but you also had a great deal of emotional selling overnight. If you don't take out the overnight low, then the odds are pretty good that you're going to get that overnight folks that have to start covering their shorts. And remember, a lot of these people that sell overnight are the most emotional traders there are. So it's very easy to get a short covering rally going on from this. So scenario one, if we don't take out the overnight low, we get a short covering rally. Scenario two, we take out the overnight low, then we start to target the 1991 range, and I believe this next one was to, I want to say that was 1983.25. So those are the first two important scenarios that I'll be looking at this morning. Normally, I don't pay any attention to overnight structure. I only want to know if the inventory is long or short. But we do have, I'm going to make this a little bigger, we do have a point of control from overnight. And you don't normally see me talk about this, but there's been a tremendous amount of selling, later in the day from this area on. So right up, they've sold it right up to the that's about the 2007 level. And so if you think about that, this is probably pretty heavy duty shorts down in here. People came in late and they're shorting as they get in the market, get in this morning. So if we stay below this level, you're not going to get any great recovery. If you start to get back above the 2007 level, then be very careful. You could really squeeze some of these late shorts in there. So my first scenario is based upon the overnight low. And those are the two big ones to start with. If we hold and don't take out the overnight low, then I'm saying, okay, if we're going to get upside acceleration, we're going to see acceptance back above the 2007 level, which was, a lot of selling has taken place from here, and this is later in the morning selling. Okay, additional questions?
Yes, thank you, Jim. Do you think do you have any bias, or do you think there's a higher probability of one movement being greater than another, up or down? And do you see the 2000 level as the line in the sand? If so, would you buy both puts and calls at that level and see what happens?
Well, first of all, one of the traps, it seems very attractive to go out and buy the puts and calls at the 2000 level. My guess is that those people that price those options are pretty smart, and I think you're going to pay probably, and I don't have them up this morning, but I think you're going to pay an awful lot of premium, if you try to buy puts and calls at the 2000 level. They probably priced that. I think that would be a very poor trade. That's what I think. I would wait and see if there's a direction to the market. No, I don't have a bias. As I said in the report last night, I didn't have a bias up or down, but I did suspect that the highest probability was for volatility, because the structure both above and below Friday's settle was very poor. So I'm looking for the potential of some volatility this week. And I said, the other thing I said, this may be a weekly scenario, which I've never written before, but it was something that I looked at. The 2000 level is surely a psychological level for short-term traders. I seriously doubt if the longer term money is focused on that. Short-term traders may be focused on that. If we take out 2,000, okay, then I said we're going to be looking at these next two references. But the first reference is the low. But again, as it stands right now, remember, this is a big week. We have an important number this morning. The ISM manufacturing number comes out. I believe that's a 9:45 or 10 o'clock number. That's an important number. We have ADP on Wednesday, and we have the first employment report of the month. So it's very important to step back and not let emotion and cognitive dissonance take over your trading personality. Okay, other questions?
Yes, thank you, Jim. I had the question here. Gosh, okay. As far as last night's trades, did you see an opportunity to sell the market when the news of the Shanghai circuit breaker hit? Would you sell into something like that?
If I was going to sell last night, when the market stopped right at the point of control from Friday, and there was no upside follow through, that is the area that caught my attention. And then by the time the circuit breaker, I don't know where we were when the circuit breaker came in here. I don't know where we were trading, but this little area, once we got and faded here, to me, this was the trade location. The rest of it, if you're going to trade it based on that, just understand that it's a very emotional trade, and you've got to monitor it very closely.
Okay, fair enough. Can you explain the difference between a prominent point of control and a very prominent point of control? Maybe you can show a couple of examples.
It's everybody wants an exact measurement. I don't have it. This is prominent. This is very prominent. And I don't know if it's a difference of 2 ticks or 3 ticks. You'll
TPOs,
see that TPOs, meaning reading from left to right. This is prominent. It sticks out. It's easy to see. This is very prominent. This is prominent. I don't know the exact number of ticks. You gain this perspective just by watching and observing over time. I'm sorry, it doesn't lend itself to a formula. This many ticks is, and this many ticks isn't. But you'll see what the real power in learning how to trade. Remember, most of our client base are short-term traders. That is a whole different ballgame than trying to trade longer term. Do we always look at the longer term to start with? Yes, we do. We think it's very important to understand the longer term in order to be successful at short-term trading. But short-term trading is a much different type of beast. Short-term trading, you are looking very much at inventory. So many times inventory gets too long, then it gets too short. It's a tremendous number of short covering rallies and long liquidation that takes place in these markets. A lot more emotion is involved when you're talking about short-term trading. A lot of people think they're going to make their living short-term trading. A lot more emotion. And you can, if you understand that emotion and you understand what your competitors are doing, you have a fighting chance in this market. Okay, other questions?
Yes, thank you, Jim. We are looking at a 30 handle gap this morning. Do you have any guidance with 1 minute to go here before the open as to how to trade the gap rules, or does a 30 handle gap make a difference?
Nope. I already said my two references this morning are the overnight low, and if they don't take the overnight low, then the chances are pretty good we get a short covering rally. They take the overnight low, then you start looking at these lower references.
Okay.
Inventory is short. There's going to be a tremendous amount of emotion in this market. And remember, anybody that's long, part of the thing that makes it so difficult when we first open here, there are traders that were long going into the weekend that don't trade overnight. They got to square up their positions this morning. We also had an options expiration on Friday. Those people that got signed over the weekend, They have to sit down and adjust positions. So this is, normally when I see something like this, I am very content. I am very content just to sit back and let the market shake out. There will be some good trades in here. I don't know, they may come up early, they may come up late. Right now, you already know that my first reference is the overnight low. Failure to take out the overnight low more than likely sets up a short covering rally. Taking out the overnight low, finding acceptance below it, then starts to target the 1991 and the 1983 level. But understand there's a tremendous amount of emotion, a tremendous number of people that are caught short this morning, are caught long, or something from the expiration, and I'd expected a lot of emotion in here this morning.
Okay. Let's just give you some time to just narrate this as we come to the, well,
Yeah,
who knows
well, you
if
can
we come
see
to it, but the overnight low.
We're still in the overnight range. We're still in the overnight range. The chances are you're going to get a lot of chop in here. This is the opening. The green dot is the opening. That is always a day time frame trader's reference. They'll look at the opening, which is also the settle from overnight, or the last trade overnight. Those will be little tiny short-term references. The overnight low will be a reference. Half back, there's half back. We're trading right. Half back is always a day time frame trader's reference. We look below half back, now we're above it. We're trading right around half back.
It's also pretty light futures volume at price, wouldn't you say?
Yeah,
I mean, there's no particular volume coming in.
A tremendous amount of confusion out here this morning. Remember, people that were, you got the expiration that took place on Friday. The question is going to be, are there people out there waiting to sell every rally? That's, there will be, the potential is that there's people out there that want to be short, but they're looking for a rally. So we got above half back. We didn't get to the opening. The most important thing, I'm sorry, the most important thing right now, if you are feeling anxious, well, you want to make a trade, you don't want to miss a trade, more than likely you should walk away from the machine. If you're feeling anxiety, could there be a long, could there be a short in here? If you're feeling that kind of anxiety, you're probably best to walk away and let this thing settle. The anxiousness to make a trade gets us into a lot of trouble. Go ahead, Julia.
Do you think the gap being a weekly gap and starting the week like this has any additional significance, or do you see any importance there?
It will get the technicians' attention because it doesn't happen very often. But I'm just going to take, I take the market one chunk at a time. You saw we put up the monthly. We've got a wide range in there. And yes, I think the weekly gap will get attention, but we'll have to see what goes on. Okay, now, we said there are going to be people waiting to sell every rally in a market like this. Okay, so now the low is weak. It's a weak low because it went exactly to the overnight. The odds of this low holding are very, very poor. For it to be a mechanical low to stop exactly at overnight, it is not a sign of strength. That is a sign that was a very mechanical low down here.
So,
but also, to stop
it lift. I'm sorry.
Yeah.
Go ahead.
No. That's
when it pops, you may be willing to sell into it, knowing that low. That's what a weak low implies.
Yes, a weak low. It's a mechanical low, but also the danger, the chances of that low holding are very poor. If that low held and the market rallied throughout the week, it'd be a pretty good chance that we come back to that low. But again, you see it's a mechanical low. If you had really serious selling, you're not going to stop exactly at the overnight low. Who would buy it exactly at the overnight low? They're going to be short-term traders. They may be taking shorts back there. If I was short, and I'm not, that would be an ideal place to take it back. Because that's going to be the high risk area. But the odds of that low holding are poor. Does it mean it can't hold? No, it definitely can hold, but it's a weak low. It's not a good solid low. And what would be a good low? A good low would be we looked below it and failed and came back in, or we stopped 4 or 5 ticks short and failed to take out that low. Okay, so now we've failed to take out that low. We've come back. I just traded exactly at half back, which is right here. So far, what we're seeing is a lot of day time frame trading in here. Go ahead with questions.
When the VIX is above 20, do you give any weight to this?
No, I expect the VIX. I expect the VIX to, to pop up on a day like this. But I don't particularly say, well, it's 20, etc. I would expect the VIX to pop. My question is, what was the VIX on Friday? What was the VIX when the market was rallying last week? Sometimes these things are just exactly opposite of what they should be. Okay, so the market came.
The VIX will be very low when the risk is very high to the upside.
It's nonsensical, but it's kind of what the emotion of traders do. It's okay. So we have a weak low. Remember, it's a good low because it's single prints. It's a weak low because it went exactly to the overnight low. The rally so far, unless I miss it, I think it's been exactly to half back. Now we're through half back. So we're getting a lot of churn and a lot of chop in here this morning.
Just for a comment, thank you, Brent. The VIX was around 17 last week.
Okay, so it was running a little bit higher than it has been. So to go back to a gap of this magnitude, to stop exactly at the overnight low is not something that gives me security that I have a low in for the week. Nor it doesn't give me security that I have a low in for today. Doesn't mean we don't, because the market's obviously very, very short, but it's certainly not something that gives me much confidence. It's very mechanical. When a market goes to exactly a mechanical low that everybody and their brother can see, that is not a particularly good sign. Now, the other side of the coin is if you had any real long-term selling in here, they could care less where overnight low was. They could care less. They'd be selling it in here. So you've got a lot of what you're going on in here. You got a lot of short-term money. You got a lot of chop, a lot of volatility. And usually when I see these kind of markets, I will just kind of let them play out. Now, what I would like, a trade that would interest me, would be to see the market take out the overnight low and then find some buyers and come back into the range. That would be far more interesting to me.
Half back is the center of the range. So you add the high plus the low divided by 2. Half back changes as you get range extension on either side.
And it's just something that, again, so much has to do with observation. And I used to relate years ago when can you hear me?
Yes.
Oh, all of a sudden I had a different sound in my ear. Years ago when I played a lot of tennis and a lot of racquetball, sometimes, particularly I can remember in tennis, all of a sudden you'd notice that your opponent was playing just a little bit too close to the center or just a little bit too much towards the outside of the, where you could pass them on either the left or the right. But to say, well, how much would that be, Jim? You don't know. It's not that well defined. It's just to say, it's just the observation that they're playing me a little bit too tight or a little bit too loose. Those little observations make all the difference in the world. And think like a tennis game. It's a very short game. You're working just like a day trader. You're working on very short-term indicators and indications and observations. And kind of day trading is very similar. You've seen this morning, you've seen us kind of talk about this early market, and it's just how, what I'm hoping you're seeing is how to observe a choppy market like this. First of all, we said the odds were pretty good it was going to be choppy. Why did we think it would be choppy? You've got the expiration from options over the weekend. You have a lot of people that were long from last week that didn't get a chance to get out. So they may be selling every rally, and you had just a tremendous amount of market on the downside. Then you saw us say, okay, that is a weak low. It was a weak low because it was exactly at the overnight low. Now you've seen that weak low taken out. So you saw the power of a weak low in action. I will guess that there is no place that you've ever talked about or heard anybody other than somebody that's been educated about this talk about weak lows and poor lows and the significance of them, particularly if you're going to be a day time frame trader. Now, I said earlier, if we take and get accepted below the overnight low, our next two references are 1991 followed by the 1983.25 level down here. I said a trade that would interest me is to look below the overnight low and then come back in with some authority. So far, that hasn't happened. But so far, we said with a gap of this magnitude, there's a lot of distortion in the market. And that's the reason that a gap of this magnitude is very seldom filled or gets substantial recovery on the day that it happens. See, now we took out the overnight low, and just feel what traders did. When they got the overnight low, short-term traders really started to press that market. They said, wow, okay, we took out that reference. And markets are very, very visual. The next visual reference was 1991. And you see that the low is 1991.50. So again, markets are very visual, particularly for the day and short-term time frames. Longer time frames, they don't even know where those references are. Now you come down and you say, okay, the low here went to 1991.50, so it's only 2 ticks above the 1991 reference. It's a good low. It's not a poor low yet because there's at least 2 ticks, but it's not an outstanding low. So my short-term references right now are 1991, and the overnight low is now resistance. This 1991 is now support. This is 2 ticks. That's not particularly good. Okay, now it's a weak low because we've now traded to 1 tick above it. So the chances of that low lasting, one more time, the chances of that low lasting are poor. Okay. What other kind of questions do we have there?
We talk about single prints. Do you believe that single prints on a gap day like this are as relevant? In other words, do you feel like there are too many single prints, or is it a different context given that it's a gap?
That's an interesting question. It is a lot of single prints, but it's not where my first focus is today. My first focus today is the overnight low. That's what when we talked about scenarios, that's what I said early on. If in fact we were going to get, we know the market's very short from overnight. If in fact we were going to get any recovery, we probably would not take out the overnight low. If we didn't take out the overnight low, then you have a pretty good chance to set up a short covering rally. We said if you take out the overnight low, then you're probably going to get, you're probably going to get another flush to the downside because everybody said, oh, we took out the overnight low. Then we said the market's very visual, and it was right down to the 1991 level. We said early on 2 ticks wasn't very good. Now it's looked below this. So now you say, okay, what would be pretty decent in here? Pretty decent in here, we look down below this level, and we start to march higher, and we get back within the overnight range. Again, if we get acceptance down below the 1991, the market then starts to shoot for the 1983 level. So this is where the action's taking place. The volume coming down to the 1991 level does not seem to be very high to me. It seems to be, you notice it's white. One of the nice things window traders out, they've colored this. So you get a chance to see what kind of volume. We don't have, it's not heavy volume. It looks like a lot of trading volume down here. But this is our reference right now. Anything on the upside, we will probably stay above the 1991 level. Then the market will start to move higher. We'll get back within the overnight range. Failure to lift from the 1991 level then begins to target the 1983 level.
Which is a daily low.
Which is a daily low.
Yeah,
yes.
It's from the 14th, I think, of December.
And markets are very, very visual. The biggest thing to remember when you get a gap like this morning is, I said, so many people, when they see a big gap, they want to buy that gap. They want to fade that gap. I would much rather fade a small gap than a big gap. When you have a big gap, the distortions of people that, from the options expiration over the weekend, from people that were long last week, that don't trade overnight, they have to make their positions right, meet their margin calls, etc. So it's very unlikely that you're going to get at least early recovery on following a big gap. If you're going to get a recovery, it's generally going to be a little bit later in the day. Well, the most important ones are if they start to buy it right on the opening and it just marches higher. High confidence and their buyers are waiting. They weren't there. Now, if there's anything, we've looked below the overnight low. We went down to our next reference. And we said if there's anything here, we look below the 1991 level. We commented that this volume on the downside wasn't very heavy relative to, to going this low. So now we have a potential buy down here. If there's anything to it, we get back within the overnight range. Okay, questions?
A comment from Michael. It's 1983.25 is also a weekly and a monthly low, just for the record.
Oh, okay, yeah, no, yes.
Yes, thank you.
Okay.
Okay, we are seeing some rotation off the lows. Okay, how could we have anticipated this move on Friday? And I think you addressed this in the report that there's poor structure below and poor structure above, but do you want to make any comment to him?
No, I wasn't anticipating this move. You saw the report on Friday. You saw I opened this meeting by covering this day right here, the 22nd. So am I surprised that we're back down there through that? No, absolutely not. Was I anticipating that from Friday? No, not at all. But the report said, I basically, when I looked at the report, I talked about the term of a weekly scenario, and one of the weekly scenarios was that we had volatility for the week. So what I was expecting was more volatility than direction. Okay, so no, and then you get some unusual things that take place. Who knows you're going to be down 7%, 6.7%, then they stop trading in Shanghai. Who knows that? I don't know that, and I never would have guessed that in a million years. You get a lot of these things that happen in the market. I'm going to come back to that in just a minute. Okay, now, a couple of things. The market early on, when it didn't take this low out immediately, we traded exactly to the overnight low, we bounced, we said that was a weak low, we bounced, we then came back and took it out. Then I commented that if there had been any real long-term selling in here, I don't think we'd have bounced. I think we'd have just gone right through it. That was an alert to be careful on the downside. Then I said, if we take this out, here's the next reference, 1991. We were 2 sticks short of it. It's okay, but it's not wonderful. Then we looked below it. We also commented that the volume looked pretty light down here. This is the point where I was feeling this was feeling like a long, and say, okay, this is a reference point. you have the potential for an asymmetric opportunity here because, you know, when you lift above this, you can put a stop right down here and you say, okay, how do I monitor for continuation? You've got to get back within the overnight range. You want to get back to the overnight range, you drag your stop someplace below the overnight range. For continuation, you want to get back up above, you're above half back. There's half back now. There's the new half back right there. You're above it. The next thing they're going to be looking at is going to be the opening. So you're back within the overnight range. But the other thing was we commented that on the downside that this was all light. It wasn't much volume. It looked to be short-term trading volume, not long-term trading volume down there. Okay, so now we're back in. So now, if there's anything on the upside, if we're going to get a short covering rally, we need to get above the opening. The opening is going to be your next upside reference. Okay, questions, Julia?
Yes, if you're long here, we have a couple of traders long, is 95, he's long at 95. What is your next reference? Obviously 2000
the next,
of the open.
No, the next reference is going to be the open is basically 2000.
Yeah.
If you've got anything meaningful on the upside, you're going to get back through this opening. You're going to get back through the psychological 2000 level. Right here, this is coming up to this opening, coming up to 2000. This is your high risk level right in here. This is your high risk level. If you've got anything on the upside, you've got to start to get above the opening. You've got to get above the early morning high, and you've got to start really showing some momentum to the upside.
Do you find that, yes, we could be having short covering, but also the fact that there's such a large gap, it's really fighting the momentum? And that when you put them next to each other, short covering versus a large gap, that the momentum to the downside wins out?
No, not necessarily. Remember, I said earlier on, what did I expected volatility this week? Remember, and I opened this and I said, the structure above this market isn't any better than the structure below this market. So but this is also a big week. Remember, there's a lot of news. It's the first week of the year. There's a lot of news coming out this week, and it's an important week. So now we're talking about this. We're going to change time periods in 7 minutes. I think you want to stay. You want to see this market get some legs. We're at 1999. 2000 is a psychological level. We said early on that the opening was always a day time frame reference. So the market's now pressing up against the opening. So the question is, if there's anything here, you start to get above the opening, you start to get above the 2000 level, and you start to one time frame higher. Right now I'm seeing short covering. I saw very weak selling down here because the volume didn't justify what was going on in here. And we got some short covering. But if you don't have any indication so far that there's any real money coming in here and say, wow, this was a great opportunity to go long this market. It may develop before the day was over, but we're not seeing it yet. If it stopped mechanically just short of the opening. So that is relatively weak selling that it stopped just short. Julia, you started to ask me a question.
Yes, could you make your profiles just a little larger so we can see this volume? The questions come up. Do you believe the higher volume that should act as support, that the market should stay above there to maintain a long position, or you're just basically using the overnight low as really a fulcrum right now?
There's a lot of chop going on in here, and I'm not going to try and make a science out of it. The only volume that really caught my attention so far was on this early downside. Comment on this was white on the downside, so there was no indication of any real selling. Now the market's coming back down. There's half back at 1995.75. We said this is a weak high up here because it stopped just short of the opening. So who was selling just short of the opening? That's going to be day time frame traders. The other traders have no idea where that is. Longer term money, they have no idea where the opening is. So our two short-term references now are the opening at about the 2000 level and half back at the 1995-75 level. So short-term traders, there's no long-term money has shown its hand either up or down this morning. Short-term traders are locked in a very tight range between 1995-75 and the 2000 level. That's where I'm focused right now. Okay, we've got 5 minutes left. We have a hard close this morning because of a meeting. But keep in mind, if you are signed up for the intensive, that when these things happen, in most cases, we're going to do our first webinar early in the morning. First hour and a half of the morning, hour and a half to 2 hours, because that's really where the market kind of gets set up for the day. Secondly, we're going to have the chat comment open. It's a one-way chat. So all day long, I will be making chats, just like I'm talking right now. I will be making chat comments pointing out some of the references and some of the things I talked about this morning, trying to help you stay on track for what is happening on a day time frame basis. And for those that are taking the continuity program, you know, the first, you start getting the reports as soon as you're signed up. The chat comments start on the 19th of January when we start the first intensive. You get full chats throughout the first intensive. Between the two intensives, I will do at least 2 chats a day, providing I'm in town. In most cases, I will be. And you'll still get the reports. And then in the final intensive, I will chat throughout the session. So what we're trying to do is stay with you for a continuous period of time so we can help you make this transition to looking at the markets a little bit differently than you probably have traditionally looked at them. Again, I will make the suggestion to try and wean yourself away from the 5-minute and 1-minute charts. I know everybody swears by them, and they're and I showed you the record. I shared with you some of the numbers in Brett's book. That stuff really very difficult. It gets you focused very tiny, and you kind of lose a larger perspective in here. But anyhow, we've got time for about one more question before we leave the session this morning.
Okay, great. Thank you, Jim. Value, you haven't touched on value. Can you just make a discussion about that?
Well, value isn't, you know, where's value going to be today? Value is going to be lower today. So value is not relevant to me today. Right now, I am simply trying to take the market one step at a time. I'm going to change time periods here in 2 minutes. This is the range that's set up so far. It's from what, 1950 to 2001. So I've got about a 10 handle. I got about a 10 handle range here. There's a lot of confusion. There are no great interest on the sell side, no great interest on the buy side so far. Yes, we had the gap. The overnight was low. We're trading just about half back. So far, nobody's showing their hand yet today. We opened. We had to deal with the people that were got caught in the expiration over the weekend, the people that had long positions they had to get out of from last week. And right now we're in about a 10 handle range, and we're going to see what develops out of this 10 handle range. The most important reference to begin with right now is going to, if there's anything on the upside, it's going to be the 2000 level, which is basically also the opening and the early morning high. If there's anything, any recovery, you're going to start to get up in this. You're going to start to get acceptance up above here. I am not impressed with the last rally that stopped just short of the opening. It's a very mechanical reference.
And Jim,
go ahead.
Pardon me, to get inside your thought process, the fact if you were long, I can imagine you'd be out because it just didn't show the lift and you're fighting momentum, just to get that in for people. Yep.
Absolutely. When it got up and it couldn't take this out,
yep.
You better believe it. Step aside.
And now ISM is out, so that's another report we're up against if you were long.
What time did ISM come out at 10 or did it come out at 9:40? Okay.
10 o'clock with construction spending.
Okay. All right. So, you get a little knee-jerk reaction from that. So I know there's a meeting. So let me say thank you very much. and we really hope that you'll join us for the upcoming intensives. Thank you all very much for your time this morning.
All right, and thank you, Jim. Great job. Thank you, everyone, for being here. We'll have this recording up midday, and God be with you, and have a great day. Great year to you all. Thanks. We'll be back here Monday, January 11th, same time, 9 a.m. Eastern. Thanks. Bye-bye.